In terms of quantum, in terms of trying to assess the overall market, there's various figures banded around. The one that I pulled out is that total assets held by Chinese insurance companies are 450 trillion yuan. So with the 10% cap, we're talking about 450 billion RMB of investment into the sector. So I don't want to vouch for the number, but it's a significant investment from Chinese insurance companies. It's a big pool of capital. I think what's important is it's growing. So premiums are increasing by approximately 30% a year. So this pool of capital is going to continue to expand. And if you look at the data of the 23 large investment deals done this year, one has been done by an insurance company, Ping An, who I think are organized and have got the infrastructure. But the majority of the rest of the insurance companies are not yet geared up for direct real estate.
As you know, insurance companies, their liabilities are very long term. I mean, they're basically policies, right? So for asset, they need to find assets to match their liabilities. And real estate is a perfect asset. Real estate has recurring income. It has long tenor, longer horizon, and they tend to be inflation hedged. So insurance companies tend to love real estate. So the involvement of insurance company is very important, but with the Chinese property market, as liquid, as heated, I guess, in some areas, Chinese government is very concerned about adding more liquidity into this market. So we see the gate actually opening up, but in a very, very slow way.
Affordable housing is a very debatable topic in China. It certainly occupies majority of the headlines. I was pretty emotional about this topic some months ago. So I even wrote a letter to a South China Morning Post, and it got published. I said, how we are going to deal with? Have you thought through this one of the largest human constructions in history? 30 million units in a 5-year time, 10 million for this year. If you assume 60 square meters per unit, you come up with it's a huge number. That is definitely one of the largest and most expensive constructions in the human history. And we know very well that urbanization creates about 15 million new citizens a year to the city. 10 million for this year, times 3 for each household, is already more than double the size of the urbanization. So just can't get around my head on how they are going to construct this portfolio. So not surprising the government cut the target for this year by 30%. By the end of this month, either they have to really massage the data, or they have to think of something better than that. Because financial burden is massive, land supply is going to be a problem. They're going to drive banks together with local governments into huge difficulty to construct this. 10 million square meters of public housing times 6 square meters of per unit. You plus another 2,500 or 4,000 for the land cost, 2,500 for the construction, another 500 RMB for the contingency budget. You come up with a number of 3.6 trillion RMB. Anyone in the room knows the actual land sale, total land sale in China for 2010? 2.7 trillion. So you know that if government really drives this 10 million affordable housing by the end of this year, lots of issues will happen. So that's why I wouldn't be surprised that they need about 12 trillion estimated funding requirement, assuming zero inflation.
That the middle class wealth is generating, they spend on two things, housing and they go shopping. So our fund actually invests in a lot of housing projects. We also like retail, although you have to be very selective in your location in picking your project. Like I wouldn't build a grade A building in a third-tier city. Whereas if you locate your shopping mall in well-served location in second, third-tier cities with good catchment and good infrastructures and transportation, you'll do fine.
State-owned enterprises in general in China are a fortunate group of corporate in China. And SOE developers and / investors are no exception at all. With much easier access to liquidity, much easier access to opportunities, favored by governments with solid supports, they will continue to be a major player in the market. I remember 3 years ago, Harvest Capital was spending like 9 months and travel around the world to raise $500, $700, $600 million for a fund. And we returned back to Hong Kong after the roadshow. We saw the newspaper that one developer based in Hong Kong, SOE, invested into Shanghai land for $1 billion. We said, that was crazy.
We call the China market now actually the perfect storm. This is the market where actually, if you have capital, you can actually get yourself into some very interesting situations.
Certainly for us, when we're underwriting anything where there's significant amount of sales onshore, the level of effective tax rates in the projects is so high that compared to commercial projects where you're looking to exit en bloc with a share sale offshore, it makes a big difference.
The old days that fund managers invest into any type of properties in China and likely to get anything between 17 and 20%, perhaps it's gone. The next phase of investment into China real estate sector will demand higher competence internally to manage risk and to manage portfolio by yourself. I think that phase is coming and cannot be reverted.